in this module, I'm going to talk about how it all really works on the side of the investor, what they need to look into, and what different things they have to get the investment made in a timely manner. That's the big thing about it. Many times we find investors who say, oh yeah, I want to invest, and when the property is ready to be closed, they say, oh, I want to do it from my IRA or my 401k or other places like that. They need to have established an account with the custodian. It's called the self-directed IRA account. So how it all works is, first the investor needs to find us, me, you, and other people who are syndicators, to find that investment opportunity that they fall in love with, that they really are excited about the returns on a cash basis, quarterly cash basis, yearly cash basis, and also the equity gain they're going to have by the end of 3 to 7 years. I know our syndication attorneys are really telling us now that because of the market where it is at in the USA, that we should plan in the PPM 3 to 7 years, because you don't want to say 3 to 5 years, because what happens in 5 years if you were not able to sell the asset, then the investors can come back at you and say, well, you wrote down on the private placement memorandum and operating agreement, I can show you right here that it's going to only go for 3 to 5 years, so I need to sell quickly. That's why we like to hedge ourselves as syndicators and say 3 to 7 years. So let's say number one, they found it now. The investors have found that investment opportunity. The second thing they have to do is open self-directed IRA account. A lot of people have IRA money, but actually they have to liquidate. They have to take the money out, sell their stocks or mutual funds, make it cash, so that that money can be transferred now into self-directed IRA account that you have just opened. Then the third thing, the investor's perspective, is to complete and submit the entity direction of investment DOI form. That's a huge part. Even if one thing is not filled in correctly, it takes longer time, and they just go back and forth. They want to make sure that everything is completely filled out from the applicant's perspective or investor's perspective. Complete and submit the entity direction of investment. It tells the Pensco or equity trust to give the money and invest that money into this particular investment that the investor wants. So it's the DOI form. Send supporting documentation for LLC, LP, C Corp, and Land Trust. So they have to send the supporting documentations from syndicators like me and you and all, so that they are able to provide all those to the equity trust or Pensco to look into that opportunity. Please look into other modules where I'm showing how custodial account manager will be able to make the feasibility. They have to really make sure that they approve the investment that their clients want to invest into. Then sign the documentation and ensure proper titling before sending. You want to make sure investors need to be totally be aware what the risks are, what the rewards are, especially the risks. And then once all the documentation is cleared, then the funds are wired or sent into the investment. So that's the number 4. The funds are sent within the LLC that you and I will form, where all the investors' money comes in, cash, IRA money, all that is coming into the property LLC, where we'll be able to use that money to close on that investment. And the number 5, which is the last part in the whole process, is to send the original supporting documentation. After everything is done and the property is closed and all the papers are signed, then they need the original supporting documents for safekeeping. I would like to talk a little bit about some of the things we cannot do in the self-directed investment from the perspective of the investor. Avoid self-dealing. That's a big no-no. in using the funds, this is a legal principle that prevents IRA owners from making investments or loans that benefit themselves or certain family members, even indirectly. It also bars mingling of your IRA and non-retirement funds, and your entire IRA could be immediately taxed. As you know, the IRAs, 401ks, rollover plans, all those are tax deferred. You're paying almost 44% tax at the top bracket. So to avoid all that is what we do by putting money into IRAs and Roth IRAs and so forth. That's why we want to make sure that we avoid self-dealing. We cannot give loans. You cannot invest your IRA money into your own deals as syndicator and so forth like that. Now, plan for distributions. Satisfying the requirements for IRA payouts can get more complicated also with the illiquid assets in your IRA. An IRA owner must take an annual required minimum distribution. It's called RMD, starting at the age 70 and a half, unless the account is in Roth IRA. Okay? Regardless of the age, must begin withdrawals from both the regular and Roth IRAs by December 31st of the year following the IRA owner's death. If somebody dies, spouse dies, or one of the person dies, then that's the ruling there. Miss an RMD, that's that required minimum distribution. If you miss that one, and the IRS could hit you with a penalty equal to 50% of the required payout. So the RMD is based on the account balance on December 31st of the previous year divided by life expectancy as listed in the IRS table. So I'm not an attorney, I'm not IRS person, so please do consult your representative to kind of give you directions on all that. Go Roth if you can. I'd like to talk a little bit about that. The distributions from a traditional IRA are taxed at ordinary federal income taxes, as you know, rates, 35%. That includes long-term gains, which outside an IRA are currently taxed at a 15% top rate. In other words, you might undercut the benefits of tax deferral by paying a much higher rate than needed on your gains. With a Roth, all withdrawals by you or your heirs are tax-free. That's the best part about Roth. I really like Roth. An investment that might appreciate greatly belongs in a Roth IRA. That is a huge point. You want to kind of give education to the investors. They would really, really appreciate it coming from a syndicator. So for IRA owners, a Roth also avoids the requirement to take yearly distributions after 70 and a half year old. Not only can that leave more for beneficiaries if you don't use the money yourself, but with assets that are partly or totally illiquid, it also avoids the cumbersome calculations of the RMD. From the perspective of the investor, they need to have an established account. They need to fund that account from their other mutual funds or stocks and have it ready. Have it ready because when there is a short window that you have to close on the property, you want the money to come into your bank account, property's bank account, LLC's account, as fast as it can.